The Fed is pretty much banked on this idea of a soft landing scenario, and the market's kind of banked on that as well, is that things are going to slow down. It's all going to be fine. Don't worry about it. But there's some things that are starting to kind of crop up that are starting to challenge that kind of soft landing narrative. As we start to move into 2026, there's a lot of things at play that are certainly going to present opportunities and also present risks. When you're looking at the data right now, it certainly suggests that one of the risks for next year is that the economy is going to slow down. If you take a look at debit and credit card spending, and that's showing a decline in activity. We're starting to see some weakness pop up in the retail consumer. Of course, that's concerning because so goes spending, so goes revenues for companies. And again, a lot of expectations right now that we're going to see a resurgence in economic activity next year. But the consumers are under pressure, and 70% of the economy is driven by consumption. On the other side of that equation, though, of course, is all this data center construction. And that's certainly going to provide a short-term boost economically speaking. One of the things that we have to understand about the data centers, yes, they're going to employ 5,000 workers to build a data center. So we're going to put a lot of people to work. We're going to create revenue. We're going to create activity in the economy and consumption of goods and services, and we're going to produce things. And that's going to create some economic growth. But once they're built, maybe you only need 500 workers to operate and maintain these massive data centers. We have to evaluate both sides. There's a lot of anticipation about the build out of these data centers and what that'll mean for economic growth, but that's not a permanent lift. And ultimately, markets are going to start to gravitate back towards the 70% of the economy that's driven by the consumers. So keeping a watch on employment, retail spending, those type of things are very important when you're starting to put together your forecast for what do you expect economically speaking, because so goes economics, so goes earnings. This is one of the key factors. There's a lot of commentary and things on Wall Street about how great things are going to be next year, and that's all fine and dandy, but it's all a function of economic growth. This is the annual earnings growth expectations for 2026 and 2027. Now, 2023, 2024, 2025, we've had very good economic growth, above the average. The vast majority of the earnings growth came from basically 7 stocks. In 23, 24, and 25, the average growth rate of earnings for the bottom 493 stocks was about 2.5%. They're expecting next year that's going to jump to 11 and 12%. So they're expecting earnings growth for the bottom 493 to surge while the earnings growth rate of the Mag 7 decline. Now think about that for a moment. That's a very different type of economic makeup all of a sudden. We're talking about shifting the entire economy away from what's been driving the economy to something else. And that's why it's important to pay attention to what's happening with earnings growth and economic growth.
Catch me daily on The Real Investment Show. The link is in the description.